Welcome to the Deep Dive. We're your guide, digging into the latest earnings calls. Today, it's Black Hills Corporation. We're looking at their second quarter 2025 results and what's next for them strategically. Got some pretty interesting numbers to unpack. So if you're an investor, maybe just watching the industry, we're going to boil down their latest announcements for you. Focus on what really matters for where they're headed. All right, let's jump in. What did Black Hills reveal?
Okay, so Black Hills Corporation, they just put out a pretty solid second quarter report. Their GAAP EPS, that's generally accepted accounting principles earnings per share, it landed at $0.38.
Right, which is pretty much what analysts were looking for. But still, that's a solid 15% jump from last year, Q2 2024, $0.33.
Yeah, exactly. And while EPS was, as expected, the revenue side, that's where things get interesting, came in at $439 million. That really beat expectations.
Oh, definitely. Consensus was what? Around $412.7 million?
Yeah.
So yeah, a nice beat there. A robust 9% increase year over year. And it's not just the top line. The operating income, that saw a healthy 17% rise too, hit $82.5 million. Wow, 17%. For utility, that's pretty significant growth.
It is. And net income for common shareholders, up 21% to $27.5 million. Management basically said, look, it's the new rates kicking in, the rider recovery, plus, weather was better compared to last year.
Right.
Even with higher operating costs, maintenance, interest, depreciation, the overall picture looks strong.
And they kept up that dividend streak too, right?
Absolutely. Their 55th consecutive annual dividend increase. 55 years, now 0.676 per share quarterly. That's quite a track record. Tells you a lot about their stability and shareholder focus.
Incredible consistency. Okay, so let's dig a bit deeper then. It's not just about Q2. They're looking ahead pretty confidently. They reaffirmed their full year 2025 EPS guidance, still looking at $4 to $4.20.
And the midpoint there implies about 5% growth over 2024. Plus, they're aiming for the upper half of their long-term target, that 4% to 6% EPS growth starting in 2026.
So sticking to the plan, what's giving them that confidence? What are the sort of key assumptions behind that guidance?
Well, it signals strong conviction for sure. They're banking on a few things. One, normal weather, always a big factor for utilities.
Right.
Two, getting continued constructive outcomes from regulators, rate investments, project approvals, that sort of thing.
Crucial.
And they're keeping an eye on costs, expecting operating and maintenance, O&M, to grow around 3.5% annually off that 2023 base.
Okay.
They also factored in some equity issuance, about $215 to $235 million, and an effective tax rate around 13%. So, for you listening, it's not just a guess, it's a detailed plan.
Built on those big investments they're making.
Yeah.
That $4.7 billion capital plan.
Exactly. That plan is really the engine here.
So walk us through some of the highlights in that plan. What are the kind of game-changing projects?
Sure. Well, a big one is the Ready Wyoming transmission project. That's about 260 miles of new lines costing around $350 million. It's on track to finish by the end of this year, 2025. And the key thing, full cost recovery starts January 2026 through a specific Wyoming transmission rider.
Ah, the riders. So they get their money back quicker, less risk.
Precisely. It avoids waiting for a full, lengthy rate case, de-risks it significantly. Then there's the South Dakota electric project, the Lange, the second-generation facility. That's 99 megawatts.
Okay.
Just got approved. Construction should start this quarter. Looking at about $280 million coming online second half of 2026. These aren't small tweaks. They're modernizing, preparing for the future.
And future-proofing definitely includes cleaner energy too, right? They mentioned the Colorado Clean Energy Plan.
Yep, making strides there, planning solar and battery projects. That's all about hitting those 2030 emission reduction targets in Colorado. Those projects are expected to come online between 2027 and 2028. So again, a clear roadmap of strategic investments driving that growth.
Right. So solid utility playbook. Invest, get regulatory approval, cleaner energy. But then there's this other factor really kicking things into high gear, the data centers. This seems different.
Oh, it absolutely is. It's a huge accelerator.
You mentioned that Wyoming electric peak load number, 379 megawatts in June, up 21% from last year, directly because of data centers and blockchain. That sounds kind of wild for utility.
It's incredibly rare, that kind of sharp, concentrated load increase. I mean, 379 megawatts, just to give you a sense, that's like powering a decent-sized city. Huge demand hitting their system.
Wow.
What's really impressive is how Black Hills is adapting, both infrastructure-wise and, importantly, with their regulations and tariffs, to grab this high-growth demand.
Well, how are they doing that?
Well, they pointed to Meta's big data center build in Wyoming. They landed them as a customer last year. Load should start ramping up in 2026.
Okay.
And they're projecting data centers will be over 10% of their total EPS by 2028. That's a significant chunk.
Yeah.
Their current 5-year forecast already includes about 500 megawatts of data center demand by the end of 2029.
500 megawatts.
Yeah. And they're serving it through what they call innovative tariffs and a market energy procurement model. Basically, it gives these big customers speed to market advantages.
Meaning they can get set up faster?
Exactly. These hyperscalers move fast, they need power fast. Black Hills seems to have figured out a way to deliver that more effectively than maybe some traditional utility approaches allow. And remember, they've been serving Microsoft's growing data center needs for over a decade already, so they have experience here.
Right. Not entirely new territory for them then, but
Yeah.
what about beyond that 500 megawatts? You mentioned unquantified upside.
Yes, and this is where it gets really interesting for the longer term. Their pipeline, the stuff they're developing plans for, it's more than 1 gigawatt of potential demand.
1 gigawatt on top of the 500 megawatts already in the plan.
Correct. Additive. Including potential new customers like Crusoe and Tallgrass, who just announced a project in southeast Wyoming.
So that current 4-6% growth target, that doesn't even fully bake in this extra gigawatt potential.
According to management, no. They explicitly said they're aiming for the upper half of that 4-6% range, doesn't include the additive impact of new data center contracts beyond what's currently baked into the 5-year plan.
Okay, that is significant potential upside. But with big growth, especially this concentrated industrial load, comes risk. How are they managing that? Grid stability, environmental stuff like wildfire risk.
Good question. They're definitely being proactive. On the wildfire front, they established an emergency public safety power shutoff program, PSPS, across all their electric utilities by June 30th.
PSPS, so that's turning off power in risky areas during extreme weather.
Essentially, yes. It's a last resort safety measure, but it's becoming a regulatory expectation, especially out west. It's about safety and compliance.
And financially, any bumps? They mentioned some unplanned outages.
They did. About $5 million in extra pre-tax O&M costs this year from those outages, roughly 6 cents per share. But they said the actual EPS hit was immaterial.
How so?
Various offsets. Some benefits related to non-controlling interest. One plant was partly owned, and also just better margin comparisons year over year. Plus, all those plants are back online now, and they've bought spare turbines, a combustor, trying to mitigate that risk going forward.
And insurance costs. Those have been rising for utilities.
Yeah, but they actually got some good news there. Just finished their renewals for July 2025 to June 2026, and they expect flat year-over-year costs. That helps predictability on the expense side.
Always good to hear. Okay, what about the balance sheet holding all this together? How are they funding that huge $4.7 billion plan?
Seems solid. They extended their main credit line out to 2030, had over $600 million in liquidity at the end of the quarter, and they're keeping their credit metrics in line, targeting SFO to debt, that's funds from operations versus total debt, in the 14% to 15% range.
Which is a key measure for rating agencies, right?
Absolutely. It shows their ability to generate cash to cover debt. They're also aiming for net debt to total capitalization around 55%. Gives them a healthy cushion above potential downgrade triggers.
And why does that matter for the average investor?
Well, strong credit ratings mean cheaper borrowing. Lower interest costs on debt frees up more capital for those growth projects we talked about, ultimately helping drive returns. They think they'll actually need less new equity funding in 2026 and beyond because cash flow should ramp up from these new projects and rate cases.
Makes sense.
They've already issued $65 million in equity this year, tracking towards that $235 million target for 2025. So it looks like thoughtful capital management.
Okay, so putting it all together.
Yeah.
What did the market think? How did investors react to all this? The stock saw a pretty modest bump, right? About 1%, closing around $57.11 after the announcement.
Yeah, fairly muted reaction. Suggests the market saw it as solid, confirming the story, but maybe not enough to dramatically re-rate the stock just yet. Kind of a bullish neutral take, perhaps.
Why do you think that is? Especially with that potentially huge data center upside.
Well, context matters. The broader utility sector, the XLU ETF, has had a really strong run, up maybe 20% over the past year. Utilities benefited from investors seeking safety, plus the general excitement about AI and data center load growth.
Right.
Black Hills, though, has lagged that sector performance over the last year. So the market might be in a show-me mode with the data center growth. A lot of that impact is still a couple of years out, and that extra gigawatt isn't officially in the guidance yet.
Oh, wait and see.
Kind of, but, for a long-term view, The project pipeline looks clear, the regulatory track record is good, and that hyperscale demand is undeniable. It sets up a potentially compelling catch-up story if they execute well, and of course that 55-year dividend streak provides a nice income base while you wait. It's a solid foundation with maybe an underappreciated growth kicker starting to ignite.
Okay, let's pivot to our not financial advice segment then. Let's lean into that potential, that underappreciated growth kicker.
Yeah.
We're talking a utility, yeah, but with this a data center angle, it almost feels like it has a bit of a tech infrastructure velocity to it. How could someone think about playing that speculatively, of course?
Exactly. It does have that quasi-tech feel, right? Wrapped in a regulated utility.
Mm-hmm.
So given that data center story, over 10% of EPS by 2028, plus that huge additive pipeline of over a gigawatt maybe you look at some long-term out-of-the-money call options.
Okay, APS, out of the money calls. Explain the thinking there.
Right. APS, long-term equity anticipation securities.
Right.
Let's say, hypothetically, buying calls with the $75 strike price expiring maybe late 2026 or early 2027. The thesis is that the market today isn't fully pricing in the compounding growth from all this data center demand. Management's being conservative, right? Their guidance doesn't even include converting that extra gigawatt pipeline. So if they start signing deals for that extra capacity, maybe a big new hyperscaler announces, or Meta and Microsoft ramp up even faster than expected. If that happens, market perception could shift pretty quickly. Suddenly, it's not just a 4-6% grower, it's something more that could push the stock well above where it is now, maybe challenge old highs. Those $75 calls, which looked far out of the money, could become quite valuable.
So it's a bet on the market waking up to the optionality hidden in that data center pipeline.
Precisely. A bet on that unquantified potential becoming quantified and the market reacting accordingly. Again, purely a thought experiment, not advice.
Understood. Okay, let's wrap this up. To summarize, Black Hills Corporation came through with a solid second quarter. Beat on revenue, reaffirmed their full-year guidance. They're clearly executing on that regulated growth plan, rate cases, big capital projects moving forward.
Yeah, the foundation looks strong. And for the longer term, that narrative is really getting supercharged by this wave of data center demand. It's a potentially powerful catalyst, maybe still flying a bit under the radar for some.
Definitely one to watch. Now remember, everyone, what we talked about today, it's for educational purposes. It is absolutely not financial advice. Please do your own homework, talk to a financial professional before making any investment decisions. But we are curious, what aspects of Black Hills' data center strategy jump out to you? How do you see this playing out? Let us know your thoughts. That's all for this deep dive. Thanks so much for tuning in. Don't forget to follow us, send us your questions. Until next time, happy investing.